All right. Thank you so much, Ekansh, sir, for taking out time for us. It really means a lot to us. We actually got a lot of questions from our 150 students for FinBridge and FinPlus batch, but we shortlisted some 6-8 students जिनके questions आपके सामने यहाँ पे screen पे share करे गए हैं. So only those students have been allowed to attend this session. The remaining students will be taking a look at the recording. And accordingly, with your permission, would like to put it on Twitter as well as, put key takeaways for the same.
Yeah, sure. I mean, I hope this session proves to be useful for your students from whatever little experience I have to share.
Thank you so much, sir. Obviously, the students, need no introduction for you. They have been following and they have been reading your blog, and which is where, we saw a tremendous amount of response from our students in terms of questions and excitement. So, with no further ado, we would like to begin the session with your permission. So, sir, the first question is from Dhruv Doshi. Dhruv Doshi is our FinBridge student. So, Dhruv, maybe you can start with your questions.
Good evening, sir.
Yeah, hi, Dhruv.
Hi. So basically, my first question is, like, Charlie Munger has mentioned that spin-offs and demergers sometimes leads to tremendous unlocking of value. It is an attractive opportunity for value investors. So what are the parameters that we should look for while analyzing, or how to calculate the arbitrage? So can you explain this with an live example, and how should it be played by retail investors like us?
So yeah, I mean, I hope first of all I'm audible.
Yes, sir.
Yeah, okay. So yeah, so basically demergers, spin-offs, I mean, we have participated a lot in these kind of opportunities. And normally, I mean, basically a spin-off acts as a trigger in a view, which sometimes can lead to value unlocking. So there may be embedded value in a company, but for various reasons, it may not get recognized. But this demerger or spin-off announcement acts as a trigger. So it's like any normal value investing scenario, value investing opportunity that you look at. So, I mean, there could be two businesses. So let's just understand why the value unlocking may happen. So there might be two businesses in a company. One might be making 100 crore PAT. Another might be contributing negatively to the profits of the company with, say, 20 crore losses. So that's 80 crore PAT for a company. And if the market is, say, valuing it at, say, 10 times, so you'll get a 800 crore market cap for that company. Now, if, say, the management decides to separate the two businesses, so that is the profitable business from, say, the loss-making business. When the loss-making business lists separately on the exchanges, it won't get a negative value, right? For a 20 crore loss. It would still get some value. It might be, say, 50 crore, 100 crore or 200 crore, whatever, depending on the assets or the potential of the business per se. So that would still get some value. So assuming it gets, say, 200 odd crore market cap. And then there is the original business or the good business, which was already doing what 100 crore PAT. And assuming it still gets the same price earnings multiple of, say, 10. So now you are getting 1,000 crore for this company and 200 crore for the loss-making business. So the value has unlocked from 800 crore earlier market cap to 1,200 crore market cap. And that's a 50% jump. So this is just a hypothetical scenario that happens. And that's how, I mean, value unlocking in general happens. It may not necessarily be the case with all the demergers. But yeah, I mean, if you analyze carefully all the businesses and if you are able to find, I mean, spaces where you think, okay, this the better business will come out with better numbers because of, say, I mean, now the ROE and ROCs for the better business will improve. So that might get higher value. Similarly, there could be a smaller unit which may not be getting much attention earlier, or so that could come out as a separate business and there could be value unlocking. So that's one of the ways to participate in these demerger opportunities, where you carefully analyze all the business parts, just like you do in any normal value investing case, and then try and determine if there is, then try and determine what could be the potential value and if you are getting a bargain or not. So that's how, in general, demergers lead to value unlocking.
So just a follow-up question on this. So let's say a business decides to demerger with, some of the other entities, and there are prospects associated with it. But then, how do you go about valuing those prospects? Then what kind of unlocking it could result into?
So prospects, I mean, as I said, you would value any normal, if you're making long-term investment, like you do any in a fundamental analysis or value investing scenario, the same part will be done in this case as well. I mean, if there are two businesses there already in that company, then you will try and individually analyze both the businesses and then determine if there is value unlocking happening or not. The second scenario could be that you may not be interested in investing in both the businesses, right? Now you could be interested in investing in a particular business. It could be a smaller company which may get more attention now, or which may have, say, certain potential going forward in terms of, I mean, like Borosil did with their
renewables.
Yeah, with their durables, and similarly like Green Panel did with their plyboard and MDF business. Okay, so just to give you an example, I mean, we participated in this opportunity around 2-3 years back. So Green Ply had both these businesses, the plyboard business and the MDF business. So and they had created huge capacity in the MDF business. While the plyboard business was continuing as it is, I mean, it was a decent operation, growing at, say, 10% year on year and with good operating metrics. In the short term, the MDF business was not doing well at all because they had created huge capacity. Same time, the other companies had also created huge capacity. So there was too much supply in comparison to the demand. And then they had also taken some loans for that because, I mean, they had almost taken 600-700 odd crore loans to finance the project. So that's when they were deciding to like kind of hive off the MDF business. That was a family settlement as well, if I remember it correctly. So you had this MDF business wherein, although currently it was reporting losses because it wasn't running at full capacity, it was running at very low capacity. It had taken a huge debt. So there were interest expenses, there were depreciation costs, and with very low capacity utilization. And and that's why the earnings of the company were quite depressed. But as I said, you won't give a negative value to that loss-making business, right? The market won't give you negative value. While at the other end, there was the plyboard business, which was doing kind of reasonably well, not a very high growth business, but good operating metrics. And therefore, you could have just invested in, at least the market was giving that opportunity at that point of time, where you could have invested in Green Ply when the two companies were still together. I think the ratio was that you would get one share of Green Panel, the MDF business, when it lists separately in the same ratio. And when Green Panel listed separately, the Green Ply stock value did not correct at all. So you almost created free of cost shares of Green Panel. And therein you could have, if someone had done a good study of that business, she could have kind of also created an opportunity in Green Panel itself, because although temporarily the business was doing bad because of all the issues that I mentioned, low capacity utilization, huge debt, and but the business still had good potential because the demand for MDF was growing. The company did not have any future capex plans, at least till the capacity reached a certain level, and you were getting it at very low valuation in terms of market cap because of the debt and all. And once the company started running the plants, once it started paying off debts, the enterprise value could have, the debt portion could have been like transferred from debt in the enterprise value to the market cap. And once all these like leverage comes down, when the debt goes down, the market gives even higher valuation. So you could have separately analyzed the Green Panel business and could have invested in that as well post demerger. So you have to basically, I mean, analyze all the businesses which are getting separated separately, do the normal value investing fundamental analysis that you do, and then decide for yourself where you are finding value. And one thing that additional happens in most of these demerger cases is when there's a small unit that is getting demerged. After listing, sometimes these stocks get sold by institutions and all, because if, say, some institution was holding Green Ply, then it was a big company for them. But this Green Panel listing was a very small portion. for them. So then they don't wish to hold on to these shares because that's a very small part of the overall portfolio, and then they kind of sell it off. And there you could get a good, as Joel Greenblatt used to call it, he used to play it. So when these smaller units get listed, suddenly there could be a huge selling pressure on those companies, and you could get a good buying opportunity if you see good prospects for those businesses.
Got it.
Sir, I can't, sir.
Yeah, sorry, your voice is not clear.
Yes, sir. Am I audible now?
Yeah, much better now.
Yes, one of the faculties at the academy. So, sir, I have one question. Sir, like while we play demergers, there are few risks that happens in demergers, like what happened with CESC, that is the time and regulatory risk. So, sir, like, and as far as my memory goes, sir, like you were also one of the participants in the CESC demerger. Sir, can you please help these young students understand how to account for those risks while playing the demerger process? That is the time and regulatory risk that may come up.
See, I mean, not all risks can be accounted for, or not all risks can be protected from. I mean, the best way to protect yourself from in general, from any kind of risk is that if there is sufficient margin of safety. I mean, it doesn't mean that you won't incur losses, or it doesn't mean that there won't be time lapses wherein, I mean, the opportunity could linger on for very long. But if at all, when you are analyzing the opportunity, there was sufficient margin of safety wherein you thought, okay, currently the valuations are quite reasonable, and with the demerger, there could be substantial value unlocking. If at all things don't materialize, I mean, as it happened in case of CESC, wherein, I mean, the demerger did not happen, wherein the regulator did not allow the transaction per se, and I think the distribution business could not get demerged. So it did lead to a situation where there was a considerable time delay. And it also led to a situation wherein, at least I think, if I remember correctly, we incurred some loss and booked out of it. So I think the best case, see, you could always do it that way, wherein you participate late in the opportunity when all the approvals are there.
Correct.
That's one way to do it. I mean, but then it doesn't necessarily mean that you would get the right valuations at that point of time, because especially in current market situations, a lot of market participants are already aware of these kind of opportunities and they get tracked a lot. So I think 10, 11 years back when we used to participate, things, it wasn't like, I mean, the discovery wasn't as fast as it is now. So we could at times participate in the opportunity once the company got the approval from the High Court, because that also gets delayed a lot, especially in unless it's a High Court of Mumbai. In other cases, it gets delayed a lot. So at that point of time, we could have participated, at least could have taken a starter position earlier, and then maybe increase the position towards the closer end of the demerger. So, but now the discovery happens very fast, and the value unlocking also happens very fast, and it may happen that even before the demerger happens, the stock may get, I mean, discovered, and the value unlocking may happen. So in that case, it all depends on how well you are protected in terms of the valuations, or that's how normally you would get margin of safety. But it doesn't mean that it will play out safe in all the cases. I mean, one has to be prepared. 2-3 cases would get wrong, and that's where you probably, how you position size, how you do position sizing, number of opportunities you participate, that's what matters in terms of how to protect yourself.
Like generally speaking, apart from depending on market scenario, if more opportunities are coming up or not, sir, how do you generally segregate your portfolio between your core positions and special situations?
So for me, frankly, I mean, I think 80-85% is still for long, medium term investment.
Okay.
And depending on, and I maintain kind of some cash liquidity at all times. I mean, it could vary depending on the market conditions. And for that cash liquidity, if there is some opportunity that comes up, say 10, 15, at the max, say 20%, then we kind of participate in those special situations. But those long-term opportunities for investment kind of remain the core thing for us at 80-85% for us.
Okay. And sir, I'm so sorry, just one final question, if you may permit, on this aspect. So, sir, there are so demergers happen due to a lot of scenarios, like how you mentioned one. was due to loss making, profit making separation. Second might be due to simplification of the capital structure of the company, like what happened in Borosri. First mergers and then demergers happened. The third scenario would be like due to very different businesses, like let's say ITC. But due to a lot of intercorporate transactions, let's say the hotel business needs support of cash flow of tobacco business. So they are not demerging it for time being. So sir, in such scenarios, let's imagine I am analyzing ITC or any such company, forget a particular name. While valuing such businesses, so do you take that demerger unlocking into account or you value it as a conglomerate?
So, I mean, it's specific to, I think, ITC per se, I don't know. I mean, I haven't like tracked it per se. So when I am looking at a demerger, I am looking again for a few simple, see, first of all, I'll tell you very frankly about me. I am a guy who doesn't understand very complex things. I get very simple things and I only look at those kind of opportunities. So if there is a business, I mean, as I mentioned about, say, green panel. So it was kind of an easy opportunity for me to analyze. So if there is something very complex which I'm unable to analyze, I would probably not get into it. And as you mentioned about, I think conglomerate and as a SOTP, like some of the parts kind of a thing.
Correct.
So I think it would depend on case to case basis. It's very difficult to generalize as to how you go about it. You will obviously have to determine if it depends on upon first of all what you are looking at, whether you are looking at smaller units that are getting demerged and looking to participate in those. Then you'll have to look at the sustainability of those businesses per se without the backing of the cash flows from the original business. But if you're looking at the overall general value unlocking, thinking that currently the market is not giving value because it's acting like a holding company because of so many businesses, then you are taking a wholesome scenario where you are probably thinking, okay, the main backbone business would itself get re-rated, and then whatever additional you'll get for other companies would be would be a cherry on the top of the cake, and that's how you would look at it.
Got my all answer. Thank you so much, sir, for answering so patiently. Thank you.
Dhruv, maybe you can begin your second question.
Yeah. So now we know how to analyze companies' businesses. So, but it is important that even if you find a good business, you won't be able to make money if you don't enter at right valuation and exit at right time. So can you explain us with a right example from your experience, what is your entry and exit strategy?
I think entry part has been discussed quite often and it's a well discussed thing. I think you are looking at valuations. If you're looking at normally a business, you kind of think of what could be the growth ahead. So entry part is also dependent on what kind of business you are analyzing. Whether it's a high quality business, high growth business at reasonable valuation, then you could probably, if you finding valuations reasonable, you could probably enter at any point of time if you think the growth would sustain and the growth trajectory would remain high. Similarly, the entry point for a very cyclical business would be very different from a high quality, high growth business. Therein you are looking at scenario. I mean, someone could be having a very deep understanding of that industry, and then she could be taking an investment based on if the cycle is turning up, if they have a deep understanding. Or someone like me who doesn't have much understanding of the industry per se would probably look at if the overall company is good and if the things are like extremely disappointing in terms of earnings and the market is not giving any value at all based on say asset price or say replacement cost value analysis. That's how I would take an entry in those stocks. I wouldn't normally know when the cycle is up turning. It could happen very next few quarters or weeks, or it could happen say after 2 years, 3 years down the line. But my thinking would be, okay, the downside is probably limited because this is a good company in the cyclical business and the industry has been through a very bad cycle. The earnings have been below average or near to cyclical lows. Stock is also near to cyclical lows in terms of asset pricing or say price to sales or price to book. That's how I would take an entry. So entry point depends again upon how you are, what kind of business you are looking at. Regarding exit, that's a very tricky thing. I think almost all the investors, value investors, they kind of find it difficult to determine how to exit. Because what would normally happen is you are sitting on a good company. See, and again, valuations is again a very subjective thing. It's not like, okay, 50x stock is trading at 40x, 50x, so it has become overpriced or overvalued and it can't go up. So you cannot normally say if this is overpriced and it won't go up. There are stocks which have gone up to say 100 times earnings, 80 times earnings or so. But there comes a point when you have done some analysis and you know this is not the time when you would be adding to that stock, or you start thinking as a value investor that stock is getting into that heated zone or overvalued zone, and you might be considering say either pruning down your position or selling the stock completely. Now this is the tricky part, whether you sell the stock completely, you prune down your position, or what you do. I would say I did not have a very clear understanding of say how to sell, or probably no one has in general. It may not sound good, but you could take some help from say chart patterns to a certain extent. I mean, even I wasn't a believer of say studying charts a few years back, and I don't study technical analysis, or I don't understand technical analysis, but I believe chart patterns tell you something. I mean, there comes a point wherein you are not sure about the fundamentals of the business. It could happen in a cyclical stock. For instance, the earnings are near cyclical peak in terms of margins or whatever they have done in the past, or the stock looks very overheated in that. You could take some help in terms of chart patterns and determine how to go about selling. You could have say a trailing stop loss strategy, because now you are not sure. The stock could fall, and especially in case of say cyclical businesses, the falls could be 60, 70, 80% when things turn around, when things turn down. And you don't want to be in a situation where you made 4x, 5x on stock, and suddenly one fine year you lose all of it, because the 80% drawdown would mean you lost whatever gains you made. So you could have some trailing stop loss strategy based on chart pattern, or based on based on some chart pattern. I think again, I would suggest one could read a book by Mark Minervini in this aspect. He has discussed various stages of a stock: a consolidation, up move, distribution, and then finally when stocks see complete capitulation, complete fall. So that would help you in to a certain extent in trying to fine tune your selling strategy. Other selling points could be like, as I try and maintain a 15-20 stocks portfolio in general. So if I'm getting some better opportunity and I'm fully invested, so I'll try and look for stocks which I'm not very sure of, or wherein I think my conviction is very low. Either it could be because of business scenario, or it could be because of valuation scenario, or whatever. So I'm trying to look for a better opportunity. It may not necessarily turn out to be a better opportunity, but at least I'll take my decision. So I'll replace that stock with a better one that I've found. Or in case of very high quality businesses, it becomes very tough to determine what should be the selling strategy. I mean, first of all, it's difficult to determine if it's a high quality business or not, because what I've realized over my last 10, 12 years of investing, there are just probably about 0.1% of the businesses listed on the exchange are very high quality, or the likes of say Asian Paints or HDFC, which have delivered year-on-year growth. I mean, not many businesses have done that, and markets like that kind of year-on-year growth, and that's when the stocks kind of get revalued or re-rated. But almost 99% or more than 99.9% of the businesses, they don't have that kind of quality, or they don't sustain that kind of year-on-year growth. They go through periods of lean earnings, they go through periods lean patches, and that's when the stocks could get really like beaten down badly, especially if you're investing in small and mid-cap spaces, because they tend to be really volatile. And when the markets are going up, they tend to give you 4-5 years returns in 1 year itself, and when they kind of correct, they tend to go down badly as well. There could be 60-70% correction on those stocks. So a lot of times you think it's a high quality business, it doesn't turn out to be that way. So you have to have some selling strategy, and that's where probably a chart patterns could help in that way. If you are already thinking that this is a stock which is overvalued, and you're probably looking to exit from a stock, but you don't want to exit just because it is overvalued, because overvaluation can continue for very long. and the stock could still double or triple from overvalued region. So you don't want to just exit because you think on an arbitrary basis that this is overvalued, and you kind of take help of chart patterns. You could take help of chart patterns of that extent.
Ekansh sir, can I ask one or two questions on the same?
Yeah, sure, please.
So first of all, fantastically explained till now regarding the exit part. Sir, I have two questions on the exit side. Sir, like as per your understanding, how are these two approaches while exiting a business? Like number one, when you use the word like pruning the position, so do you personally keep any such indicator in mind that is the upward threshold? For example, you may have taken 5-7% at cost a particular business and it rallied, one or two outliers happened, and it is crossing, let's say, 15, 18, 20% of your overall portfolio. So can that upper benchmark be also used as an exit strategy, that the maximum I would like to hold is, let's say, 15% in a business or 25% in a sector?
No, surely. I mean, a lot of investors do that, and I think even I would like to be very cognizant of the fact if a certain stock position exceeds say 20%, or say a sector exceeds 30%, I would be very watchful of that stock and sector per se, and because it also depends on the liquidity situation of that company or the markets, because I normally invest in small cap companies. So when say a 5% position could become a say 20% position, it could mean that in case of say a situation where the markets are correcting deeply or the stock starts witnessing deep correction, I could be facing problems in terms of exiting the stock. So a 20% for a stock does become that kind of a threshold or that mark wherein I would start looking at it very, very keenly, and would try and determine if and when I have to prune down my position or reduce my position in that stock. And similarly, around say 30% for a particular sector.
Okay. So just one final follow-up on this exit part. Now, sir, when we are talking about those two typical scenarios where market loves quality businesses or overvaluation may continue for a very, very long period of time. Sir, like I would like your point of view on my understanding here. A lot of people, and I personally, I follow that expected IRR logic from a point of time. So, do you also believe that exit strategy also depends a lot on a particular investor's time horizon? For example, I am an institutional based fund of United States. I am making 2-3% in US, and let's say Infosys or HUL can give me a 9-10% compounding for a very long period of time. So even though we being Indians might be going mad over the current valuations of the company, but those investors might like to hold it for a very long period of time, versus people like us, me specifically, we want to make a decent alpha in 3 to 5 years because we need to build wealth. And for such people, like at every point of time, do you think it becomes necessary to analyze कि अब स्टॉक यहाँ तक पहुंच चुका है, यहाँ से 3 साल के अंदर वो 20-22% का केगर बनेगा कि नहीं बनेगा, अदरवाइज स्टार्ट एग्जिटिंग द पोजीशन?
So 20-22% का केगर बनेगा कि नहीं बनेगा, it would depend on, I think, both earnings and how the stocks is getting either re-rated or de-rated.
Correct.
So earnings part, again, it's not exactly science, or you cannot determine perfectly, but you would have some idea based on say management attraction or management guidance or how the business has been panning out. But re-rating part is something which has become very arbitrary over the last few years. Now, how do you determine? I mean, I remember there used to be stocks wherein we used to start saying, okay, the stock is becoming overvalued 30-35 times earning. But now I see a certain, I mean, these are exceptions, of course, but a lot of stocks, I mean, very normal businesses, I mean, obviously they have done well in terms of, I mean, growth and other metrics. But how do you say, I mean, a building products company could get could trade at say 90 times earnings or 100 times earnings? I mean, we haven't seen that in the past, and it's not like that it's just a small short phenomena and then they are crashing down. No, they are sustaining that.
Correct.
So, and you kind of exited at say 35, 40 times. And when you're determining that CAGR for the next 3 years, you have to determine the exit valuation, right? Exit multiple.
Correct, sir.
So, and that again kind of becomes a bit difficult. I mean, you would assume say for a 30, 35 stock, a 25p.
Absolutely.
Or say 30p and determine, and you would come out with a very small value, say 9% CAGR. It happens, right? Because
Correct.
when we are doing, when we are making assumptions about earnings as well, we kind of be a little conservative if the company say, and then we apply a lower multiple and you get a small CAGR, a low CAGR. So it is, as I said, very tricky per se. And that's where to a certain extent, it's not a science, it's an art. So maybe you could take some help of chart patterns as well to a certain extent. So basically we are looking for patterns. I mean, even when we do fundamental analysis, we are still looking for patterns which have made money, right? Companies which have shown growth, companies with good operating metrics, companies. So these are again patterns. So what I'm saying is that maybe add one more tool, which could be say chart patterns. Just know about it. It's not like you are applying it all the time and doing that, but knowing that will help. It won't necessarily reduce your knowledge about fundamental or value investing, right?
And it's a perfect, sir. Completely practically answered. So just, I'm so sorry. Based on an answer, just one last question. So, sir, sir, in your experience, although you have applied it for a limited period of time, sir, any particular chart pattern that you have come across that shows sign of a persistent breakdown in the stock, like a very quality stock breaking 200 EMA type of an indicator that you have come across that you have faith in? If this shows sign of exit.
Yeah, so that is one of them. Then, as you mentioned, 200 EMA. But I think I'm more looking at patterns like consolidation patterns, or there is a pattern called Burj Khalifa pattern as well, as you may be aware. I mean, the stocks go up, I mean, make a big, huge move in a very short period of time, and then they start like there's a capitulation, and then there's a complete downtrend. So you are trying to determine if the stock is persisting in terms of downtrend or not, and if it is forming a base or not. If it's forming a base, you could maybe defer your selling and see if it breaks below a certain level or not. So as a value investor, I mean, we are not completely following it. It's not easy to do. Sometimes you even think of certain stop losses and then you try and kind of move them down, because it's not easy as a value investor to exit. I mean, you like businesses in that way and you are finding earnings good. But yeah, those are patterns. I mean, you look for downward trends or upward trends or consolidation. If the stock is consolidating, that's fine. I mean, but if it's a continuous downtrend, then maybe you will have to take a
on stop loss. We need to at least prune the position.
Prune the position, or have a trailing stop loss kind of. Don't say trailing stop loss. Maybe a profit protection strategy if it sounds
correct. Good. Correct. Got your answer. Thank you so much, sir. Once again, thank you.
Thank you, sir, for this detailed answer. Dhruv, maybe you can proceed with your third question.
Management, while analyzing management, so should we analyze like the management interest? Is it aligned with the shareholders' interest? And management cannot be only be prepared for the minorities' interest. And there are many other and what are the parameters and issues that should be ignored or should be kept in notice while analyzing the management?
So I think, I mean, India is slightly a unique case. And if you're investing in small businesses, small mid-cap companies, I mean, I personally like to invest in owner-operated businesses. And in India, they have done well. They have delivered value for the shareholders in general. So normally, I mean, there are certain businesses wherein the promoters may have, say, slightly lower holding of, say, less than 50%, but there are few in our portfolio, probably 1 out of or 2 out of 20. But normally I would look at companies which have, say, 45-50% or more in terms of promoter holding. Then I would also look at whether there are other companies for the same management, same promoters in the same line of business or not. I mean, you try and look at related party transactions a lot. And I think the best way to understand is to look at the past numbers as well. I mean, a history or how they have gone about it tells you a lot. I mean, the looking at past 5-10 years numbers, it doesn't necessarily tell you everything, but it does tell you what they have done. I mean, so what happens with us is that we don't normally invest in recently listed companies, IPOs, and we normally do it after say 4 years, 5 years or so. Why? Because we don't have a track record as to how they would treat the minority shareholders. I mean, and there's also a saying that when the IPO comes in, a lot of numbers, uh, they are kind of made better than they are. So in India, you have a lot of these companies which have been listed for 20, 25 years. And when you're looking at these small companies, you could look at the past 10 years record and determine what kind of actions that they have taken, which might have been detrimental to the interest of the investors. So if they have been like someone who have been constantly diluting equity, you would try and avoid those kind of companies. But I find a lot of companies who have done very well, no equity dilution as such. They may not be very pristine in terms of corporate governance. There could be slightly higher salaries for the management. There might be lower dividend payout, or at times I have also found companies wherein there are certain related party transactions which you would not want them to happen. But then there are still like 90% of that is still, I mean, in terms of delivery of performance, in terms of how they have managed the balance sheet, in terms of how well they have deployed the capital and the growth that they have delivered on that capital. So that has all been good. They have high promoter holding, 60, 70 odd percent. So that's where you take a call and kind of ignore certain issues, or you think, or if the valuations are very reasonable, and you kind of still take a call and invest in those companies. But a very low promoter holding, or say constant dilution, or too many acquisitions of companies, or so those are the kind of situations wherein you would like to avoid or not get involved in those kind of companies in general.
Got it. Dhruv, you have any follow-up question on that, or maybe you can start with the fourth one?
Yeah, I'll go with both. Yeah. So there are almost 6,000 listed companies in BSE and 2,000 companies on NSE. So like, and we read newspapers and magazines, we get 50, 60 companies every day, analysis and all. But we can't analyze every company for idea generation, for wealth generation. So what are your parameters? What do you keep in notice while generating ideas in the market?
So now, in fact, it has become quite good. I mean, there are so many good tools now. You have Tejori, you have Screener, you have, I think, few more tools wherein you could put in your parameters, run a screen, and you would get a list of say 200 odd companies. So for instance, I'll just give you an example. We look at companies which may have done a major capex in the last 2-3 years. Okay, so that's one of the screens that we run. We get around 150, 200 odd companies, and we look at those companies. Similarly, we look at companies. I mean, one of the thought processes to look at good companies going through a rough patch. So we'll have certain parameters wherein there is, I mean, high promoter holding, some dividend yield greater than 0, okay, and some growth year on year. But the current operating margins might be low than the last 5 years operating margin. So we would again get say a list of 150, 200 companies on Screener, and then we would look at individually at each of those companies. Obviously, you won't do it in one day, but you could do it over a period of month. And a lot of those 150, 200 companies will probably get say 10 odd companies to add to your watch list. And that's how you build your watch list, because when you're going through these companies on these tools, there are companies wherein you'll just look at numbers and you'll determine, okay, in just 2 minutes that this is the kind of company you're not interested in, and you would just simply kind of move on to the next one. But then there are certain companies wherein you would say spend 10-15 minutes and you would find them attractive and add to your watch list. So that's how we develop or add stocks to our watch list, by having various screens, 2-3. I mean, you develop mental models wherein one could be a consistent compounder, although right now in the current market situation, if a company has all the high quality parameters and good growth, you won't normally get a good opportunity, but you could still add those companies to your watch list. Maybe something pans out, say a March 20 kind of a situation wherein all the stocks are falling, and then you could add those. Similarly, as I mentioned, two other parameters for screening companies: high capex done over the last 3 years or so, or say a good company going through a bad phase. So that's how, and then we go through daily announcements, corporate announcements, and sometimes we do, I mean, a lot of times it becomes boring as well going to corporate announcements sometimes when there are a lot many announcements, but oftentimes maybe in a week or two you would get an opportunity to add to your watch list. And that's how you build up your watch list. You look at those stocks, and then you could also look for cyclical opportunities. I mean, we were earlier not participating a few years back, but recently in the last 2-3 odd years, we have done well, and we looked at so many patterns and thought everyone looks at, say, a 10-year chart of a cyclical company and thinks no value creation. But then the other way to look at those companies is they go through 80% drawdown, then they make 5x, 10x on stock. So why can't you look for an opportunity where you could buy when they have fallen quite a lot, and maybe look for a 3x, 4x, 10x opportunity if it happens? I mean, what is the harm in that? And those may add incredibly well to your portfolio in terms of returns. So that could be one of the baskets. So now there are so many tools to like search for companies or add companies to your watch list. But you should have a certain mindset in terms of what you're looking for, because that's when you will be able to add companies or determine what you were looking for. And if you find certain parameters matching to what you were looking for, then you could add them to your watch list.
Thank you so much, sir, for answering my questions.
Yeah, thank you, Rav.
Thank you so much, sir. So the next set of questions is by Rikin Shah. Unfortunately, due to an emergency, he couldn't attend the session, but I'll try and ask his questions. So Rikin is one of our alumni. He's working with Omkara Capital. His questions, I'll start with the beginning. So you mentioned in your previous answers that you don't really invest in companies who don't really have, until 4-5 years of history for you to take a look at the performances. But let's say, what if the company is like a micro cap or a small cap where disclosures aren't really that readily available, or they don't really have a execution history or large capex history? So how do you go about dealing with these situations?
I wouldn't invest. I mean, if there's not much history, or if I don't have much details on the company, I mean, as I said, I mean, I'm looking for at least 5-10 years performance history per se, or other things. But if that is not there, I wouldn't invest. I mean, see, I mean, lack of disclosures is a thing which is there in small cap space. So you look at annual reports, you do all that stuff, but you won't necessarily find all the information. But the beauty of small cap space is that a lot of times stocks are undiscovered, even though they might be performing really. I mean, take for instance the situation of 2018-19. So I mean, the stocks had been butchered after peaking out in Jan 18, and you could get some incredible stocks, at least in terms of what they had done in terms of performance, and the valuations were quite reasonable, very reasonable, even though there was lack of disclosures. But then if you sum it up, I mean, it's like you position yourself to be lucky in stock market. Okay, that's how at least I look at investing. So when I see the downside is limited, but if the company continues delivering and things could pan out in a way that I might accrue great returns on that stock. So that's how I would invest. But if there's a situation where there's a complete lack of information in terms of financial history of the company or operating history of the company, I wouldn't invest in that stock. I mean, anyways, there's no lack of opportunities per se. So why would I look at that space and waste my time?
I think that answers the question. So the next question is more of a bit of a question around career advice. Like he has entered the market just a year or two back, and he's asking whether he should be focusing on becoming a sector specialist or a generalist. What would be your career advice in that sense?
I'm not. I mean, I'm not a sector specialist. I'm a generalist, so my answer would be biased. I mean, and I think there might be a lot of sector specialists who may be doing incredibly well with their portfolio because they would know so much about that particular sector, And if they are able to time their entry and exit very well in that sector, they would be making huge returns per se. But I'm a generalist, so my answer is biased in that sense. I mean, and it's also about how do you enjoy working. I mean, I cannot keep looking at a particular sector. I would get bored. So that's why I'm a generalist. I'm looking for opportunities, and opportunities for me could come from any space.
Got it.
So, but I mean, there are people who would enjoy working on a specific sector. So, but I think a lot of mostly the investors, I'm not talking about analyst, I'm talking about investor. So I think a lot of investors are generalists. I might be wrong, but at least that's what we have seen.
Makes sense. So the last question from Rikin, and there are actually a couple of bullets in there. So I'll quickly summarize those questions. So he's more curious on the front, like how do you know, are there any particular triggers like which create that curiosity in your head that maybe you would want to add that particular stock to your watch list, which you just mentioned a couple of minutes back? Like any particular triggers, like you mentioned capex being one of those, and any other factors which you keep in mind, which grab your curiosity when it comes to idea tracking or maybe generation?
So yeah, as I said, it would depend on the basket that I'm looking at. I mean, if it's a capex driven business wherein I'm looking for a stock which have done huge capex, then I would get excited if I'm finding, I mean, the company has completed the capex, right? And maybe the debt has kind of peaked off, or the company, and the market has also, I mean, the market situation should also be favorable. Right now, in 2022, when the markets have run up, even though the earnings of the company may not be coming up despite carrying out the capex, and the company might be reporting bad numbers because of all the issues related to capex, but the stocks would still be trading high because everyone is tracking those kind of strategies or those kind of stories. But in 2018-19, you could get those stocks at depressed valuations, despite the fact that the companies had created asset base which they could start milking as things improve, and the debt had peaked off. So that is one of those things. I mean, a stock, if the company has done a huge capex, the valuations look kind of low, and the stock has kind of corrected a lot, I would get interested in that stock. Similarly, if I'm looking at companies going through bad phase, so I mean, for instance, we participated in pharma companies 2-3 years back, and we also exited in a certain pharma API stock around a year back. Now I was looking at that stock again at that so the margins for that company have again contracted. They could not sustain the kind of margins that they were making in, say, FY21, because the prices have now kind of declined, and the stock has corrected 50-60%. So in my back of the mind, I know that the company is good in terms of what they have done in the past. There was a momentary period where the earnings shot up quite a lot. The stock shot up quite a lot. We made an exit and we got a good opportunity, but now the stock is again down 50-60%. So that is kind of again getting interesting for me, because that's a good company again started going through a slightly bad phase. The earnings, the margins have again contracted. The stock is down 50-60%. So that is becoming interesting for me. And then in 2018-19 kind of market situation, you could get, I mean, there were companies, steady compounders, unknown names though, but still available at 8-10 times earnings, and with very good balance sheets and all. So that was interesting then. So it depends on market situation as well. I mean, right now I would be looking at spaces which are slightly out of where the market is not appreciating those spaces, either because of current near-term margin or earnings contraction, because otherwise anything which is doing well, anyways the market is rewarding that space, and we may be already invested in some of those stocks. But if I have to look at a new opportunity, I have to look at spaces where, I mean, the market or the exuberance is not there at all. Maybe I may not make money for 1 or 2 years on that stock, but when things turn around, I would in general make decent sums on that. So just to give you an example, I mean, so I'll just a disclosure, I'm a SEBI registered research analyst, and some of the stocks which like we have discussed, I may be owning or we may have recommended. So like Cupid is a stock which we kind of recommended a few months back to our clients. There was no interest in the stock. The stock is probably down 50% from its peak 5-6 years back. Everyone had negative comments per se, because the performance, near-term performance has been bad. And we kind of looked at the stock. We found that there was COVID-related issue as well in terms of them getting the orders in the stock. That's why the earnings kind of dipped for the company, and a certain segment was underperforming because of, again, COVID. And it looked like things could again start improving for the company. And then they were also looking to foray into US through a US FDA approval. And the process is still on for that. They haven't got the approval for one of their products, the female condoms. But if those things materialize, you could end up making, the company could do really well. At the same time, if those things do not materialize, anyways, the stock has no interest at all. And maybe it may happen that 2 years on the line, 3 years on the line, we would still exit at say 15-20% loss. But if things materialize, we could make quite good sums from that company. So that was an interesting thing. That's how we look at. So normally, if there are spaces where there's not much expectation of the market or exuberance, or the stock has been through a long consolidation and it seems like the earnings could pick up, we get interested in those kind of stocks.
So in fact, on exactly the same thing, we had a general question, like how do you differentiate between the structural changes and cyclical growth, and especially, the API margin contraction, which you talked about? Like, how do you identify, like, you are at a peak margin and probably, it's time for you to, exit, or, how do you identify the time to enter in these kind of situations?
So again, as I said, entering was relatively easy because when we entered, the margins were kind of near mean levels or rather low in API. And I think the pharma space kind of earlier peaked out in 2017, maybe, or no, not 17, probably in 2015. And by 2017-18, the stocks are already down, and quite a lot of stocks in the pharma space were down. So we were getting a good entry opportunity because the valuations were low. I mean, the stock had corrected from 2015 odd peak, and the earnings in terms of at least the margins were near cyclical lows or near mean levels while the sales were growing. So entry was an easy thing. Regarding when to exit, so again, it's, as I said, it's tricky. I mean, I didn't know for sure whether the API had the peak margins or not. But sometimes you make an early exit and there are companies going through a product mix transformation or some structural changes where the margins could keep on expanding. And so that's where you use a combination of, I mean, your understanding of the business margins or business cycle and chart pattern, wherein if the market is not supporting that thing as well and the stock is making, say, going through a downward phase or downward trend and even breaking below certain support levels, and you also fundamentally analyze and think, okay, the margins may not further exceed from that. So you kind of take an exit. So again, it's not a very, very pure scientific call.
I think,
just one thing. Ekansh said, will I be right to distinguish cyclical and structural change on this parameter? So whenever margins are expanding for a particular business, first thing that we can look at, is it happening for an individual company or it is happening across the board in the sector? That might give us the first indication that this is a cyclical uptick because everyone is benefiting from the same. And second indicator can be like expansion of margin at gross level or the EBIT level. So if gross margins are expanding and not due to the segmental mix change or the product mix change, but due to enhancement of the finished good prices or a raw material downturn, that can be classified as a cyclical thing. Is it the right way to look at it?
I think you made beautiful points regarding, both the points are quite good. But one thing, sometimes even though the whole industry might be going through a cyclical phase, but you don't know per se itself whether this industry is going through a structural change or not.
Correct, sir.
It happened in the case of chemicals, right, in
Correct.
India. Correct. So if you remember, probably 5-10 years back, they used to be treated, all the
2012-13,
single digit, all of them were treated as commodity companies. There was never mention of specialty. But I think a 6-7 years change is, whether it's a cyclical or structural, I don't know, but a 6-7 years change, it can lead to huge wealth creation. And it has already created huge wealth for a lot of investors. Right. So So structural changes can also be cyclical depending on the length of
the cause of margin expansion.
Yeah.
Thank you so much, sir.
Thank you so much.
Thank you.
Yeah, actually answers it pretty well. Moving to the next question by Dhruv Rathod. Dhruv Rathod is our FinBit student. Dhruv, maybe you can begin with your question.
Sure, thank you, sir. Sir, first of all, your blogs have been a great source of knowledge for all of us. Thank you so much for that. Sir, my batchmate Dhruv Doshi asked about idea creation previously, and you gave an answer about how to run screens and also what all criteria do you check. So once you get these ideas, it's extremely difficult to analyze every investment and idea you come across because there are very many companies on our screens. Hence, sir, my question is how do you apply the first cut where the initial good parameters and the red flags you see while analyzing a business, and you know that this is to be analyzed in depth and this is not to be analyzed in depth.
So, I mean, it's a tricky one because it would depend on what kind of opportunity you are looking at. I mean, if you're looking at a cyclical basket, but you find them near, I mean, when the cycle is already quite good or quite high, I mean, even though the company might be good, but you may not necessarily add them to your watch list. You would just simply kind of brush them off and maybe look at them 2-3 years down the line. So, I mean, it's difficult. I mean, when you get 200 odd companies in a screen, you could, or say 100 or 150 odd companies, we try and look at say 10-15 odd companies, run through those 10-15 companies and maybe get only one to add to our watch list in our day. Or so, I mean, a lot of times, I mean, if the stock has run up a lot, and if I'm seeing like the margins have kind of expanded a lot, the earnings don't seem sustainable in general, based on my cursory analysis. I mean, I could be wrong as well, wherein, I mean, the company could continue doing well. But so that's where we kind of not look at those companies. The idea is to look for best opportunities to add. So, I mean, as I said, we keep looking for companies wherein the market is not like rewarding them, or market is not too exuberant about those companies. And it seems like maybe the margins are near mean or cyclical lows or whatever, and the company is going through a temporary bad phase, and the market is also like kind of acknowledging it's going through a bad phase, and you add them to your watch list. So it's difficult but there are certain cases where you just look at a company at 1 or 2 minutes and you kind of just close that company and don't further do an analysis. So it could either be because you find them doing constant equity dilution. It could be because you may find, I mean, the overall track record for the past 5-10 years, you may not find that any attractive at all. I mean, so those are the things you look at, but it's difficult to say what is the exact thing which kind of, because it depends also on the kind of companies you are looking at. I'm sorry, I'm not able to clearly answer that, but it's up to each individual investor.
Yes, sir.
I mean, you develop it over a period of time.
Sure, sir. Got it. Thank you very much, sir. Sir, secondly, I had a question from one of your blogs, where you had put up a comparative analysis on Bajaj Finance. So, Bajaj Finance was on Bajaj Finance versus PayTM. You had put up a blog where you said that you can't compare these businesses. So I understood from that blog that there are high chances of your prediction going right in Bajaj Finance because you have numbers of 2 decades or even more, you can say. But you can go wrong in businesses like PayTM who change or pivot their businesses drastically. So how do you see businesses like PayTM while you analyze them? Are there some factors, or you simply stay away from businesses who change their operating activities constantly?
Yeah, so it's quite simple. We stay away from them. First of all, it's a recently listed company. We don't have any track record. I mean, we are very simple, normal investors. As I said, we understand very simple things. And PayTM is something which goes way, way beyond our head. I mean, first of all, I mean, we don't understand the normal current business, and then the business also like kind of changes every few quarters or every few weeks or something. So I mean, how do I really analyze that? And I mean, I just stay away. I mean, there are 5,000 listed companies, that there are a lot of spaces where investors are not even looking at. So I mean, when you can, it's like when you can make returns doing simple things, why complicate your life? I mean, it may sound good to analyze or talk about PayTM in amongst your friends, or I mean in a social group, but I mean the purpose of being investors to make money, at least for me.
Got it, sir. Got it. Thank you so much for that answer. Sir, my final question is on more on the startup sides. A lot of new age startups like CarTrade, recently Zomato, Nykaa, PayTM are getting listed in the Indian markets, which do not have much of the operating history. Although after reading your blogs, I know that you don't invest in IPOs, but you may have still tried to analyze the quality and performance of such businesses. Hence, my question is, what business aspects or operating parameters do you focus on while studying such businesses in depth?
Again, I'm sorry. I mean, the answer is kind of same. See, we have limited period of time, right? You go about their DRHPs, you go about their presentations. Those are 100, 200, 500 pages. Ultimately, in most probable case, I won't be investing in those companies. A lot of things would go over my head. I have limited period of time for analysis. So my time is better spent on looking for opportunities where I would rather be making investments, at least right now. I mean, one could do some study for academic purpose, but at least till now we haven't spent that kind of time trying to, because we are still spending too much time on running our screens and trying to find opportunities to make money. As I said, normally we won't be investing in those companies because they don't have 4-5 years operating history. A lot of times we won't even understand the business, and they are not making, I think, profits as well per se. So I don't know how to value those companies. So I don't spend much time. In fact, no time at all, unless there is some article by say ET Prime or somewhere. I may go through it, but I don't spend time.
So just one counter question on Dhruv's question, and particularly your mindset. Like sir, even I have been a avid reader of whatever reports you have published since 2011, while I started working under Ashish Kila sir. So I have been reading you, sir, since I think 2010, when I think Catalyst came into a picture. And so, sir, my question was on that parameter, that are you, because I have found you very open in terms of the kind of business you analyze, from cement to chemical to FMCG, you have analyzed every business. So the main reason of you particularly staying away from such young companies is due to lack of operating history, or one very important line you mentioned, that is that how they will treat minority. Because let's imagine if a Haldirams come up with an IPO, so they might have a 25-30 years of operating history. So that thing will get out of picture. Ki operating history to hai. So the main angle is about minority shareholder treatment or the history aspect?
History aspect, valuations as well.
Okay.
Haldiram, if it comes up with an IPO, I would be probably very interested in looking at that company. But as you understand, IPOs don't, I mean, they could still make money because of re-rating and stocks getting traded from 80 times earnings to 200 times earnings for whatever reason. But normally they don't come at those kind of valuations wherein you would find them bargains, reasonably valued.
Correct.
If they come at those kind of bargains, I would be more than interested in looking at those kind of companies if I believe there is opportunity for growth. I mean, therein I might, as you mentioned, say something about Haldiram. If it is very mouth-watering, or say even after listing, there it happens that stock kind of corrects. I mean, a lot of IPOs kind of correct because of market cycle or whatever.
Correct.
So I may get interested if I find, even if I may not have the complete knowledge or detailed knowledge of as to how they would treat minority investors. But if you can't get 10 out of 10 things right when investing in a business. Correct. You have to have some leeway, or you have to determine wherein you are kind of can make a compromise to a certain extent with your investing parameters. So it may happen that even though I don't know how they would treat minority investors, but if I get something as good probably as a Haldiram, at least what it seems like, and with growth opportunities and reasonable valuations, I may still consider it.
Okay, so again, the summary meaning like you are not against that domain, but the base rate of good opportunities you find are very low, where you can make money actually at the time of IPO. So you don't waste time there.
Yeah, so one other point is very limited time period we all have, and we have to ensure that we work on spaces where we are looking to at least get an opportunity to invest.
Thank you so much, sir. Dhruv, you have any particular question?
Thank you so much, sir, for answering all my questions. Thank you very much.
Yeah, thank you, Dhruv. Thanks.
Okay. Sir, the next question is from Jayati Vyas. She's our Finbridge program student currently. So Jayati, please go ahead with your question.
Good evening, sir. Thank you so much for opportunity.
Thank you, Jayati.
Sir, in one of the blog, you mentioned about delisting, and you stated that if the company is delisting, something good can happen in next 2 or 3 years, and failure in this delisting can throw good opportunities. So what are the parameters that one should look by analyzing a delisting of a company? That is, one should look for a capex, like what happened in Vedanta before delisting, and basically a year back. And also, given an opposite situation, when company successfully delisted, should we look for the peers that something may good happen with them also?
Yeah, so your point is exactly right regarding the second point. I mean, if some company, so my whole idea was, I mean, it's not a proven study or something. We looked at the past few cases, and see, the whole idea is that promoters know something. In fact, they know much better than us investors. They are the ones running the business day in, day out. They know the industry much better than us. So a lot of times, I mean, if you think just psychological aspect of it, if the promoters are basically increasing their stake. So in any normal situation, what you do is you look at companies where promoters are increasing stake. And as Peter Lynch says, is that a lot of times the promoters are increasing stake, they are normally doing it because they believe that there is some potential for the industry or something good is happening. So same scenario, if you look at, say, delisting, a promoter is holding 70-75%. They are looking to increase their stake to 100%. They probably also might be finding the valuations attractive. That's why they are looking at making it 100% and just get away from the market. Obviously, they don't want to get into that compliance part or reduce that. So that was just a normal observation. We looked at a lot of cases and we found that a lot of times delistings come up when the industry has been, or the stock has been through a certain bad phase, say a bad earnings phase or something, or the industry. For instance, if I remember correctly, during Vedanta, I mean, the metal space was down in the dumps, right? So, and as I know, I mean, he's a good businessman. He's a shrewd businessman and he knows business well. So he may have found incredible opportunity or incredible value in the company when he thought of delisting. And same thing we found with a lot of other cases as well. I mean, and we tried to do some analysis, and a lot of times 2-3 years down the line, the numbers kind of improved for those companies. So again, as I keep talking about trying to find out patterns. So that was one of the patterns that we were looking at, because normally what would happen is we were participating in delisting opportunities for the run up in the stock, right? And we played that quite often and it did work out well. But then we found out recently a lot of delistings are also failing. And what happens after, if the delisting fails, is that the stock kind of crashes after that, normally 20-30 odd %. And a lot of times then it goes for consolidation phase as well. And then a lot of stocks made an up move. So that was the pattern we found, that a lot of stocks, after correcting post delisting failure, they kind of consolidated, made an up move. So we looked at a lot of companies. I won't say a lot of, but maybe the companies that we looked at, 5, 6, 7, 8 odd companies. And we found this pattern that the earnings were kind of depressed or the valuations are low based on, say, asset size or earnings. And then the earnings kind of improved for the company, even though the delisting failed, and the stock kind of made an up move. So yeah, so that's the pattern. I mean, it may not necessarily work out every time, but it does look like a good pattern to follow and track. And as you pointed out about the second aspect, is that you could surely look at the peers or the other companies in that industry and look for if things are going to turn around. Or I mean, you could start analyzing the prospects or look if they have been going through a bad phase or consolidation phase and if things are turning around. So that could create an opportunity, even though not necessarily in the company that got delisted or planned a delisting, but in some other company.
Thank you so much, sir, for your answer.
Yeah, thank you.
Thank you so much, sir. I think, sir, the second last candidate would be Preet Jain. He's from our FinBridge program. So, Preet, beta, you can please start with your set of questions.
Good evening, sir.
Yeah, hi,
Sir,
Preet.
sir, in one of your article, you have the reasons that why one should buy only mid and small cap companies, in which you give many factors like they are undiscovered and they are largely owner controlled. And in above answers, you also told that you majorly invest in small cap companies. So, sir, as we know that in Indian market, 75 to 80% of volumes are traded in large cap and only 15 to 20% in small caps. So, sir, and as an investor, we can't predict the cycle of small, mid, and large cap. And as we know that when correction happens, it happens mostly in small caps. It happens largely in small caps. So at that moment, how one will restructure its portfolio, as exit is not easy in small cap due to the limited volumes, as you told above. So what should an ideal investor do that at that moment? Should he play safe by buying some portions of portfolio into large cap as suggested by Peter Lynch?
Yeah, see, I mean, it's completely up to an individual how she is willing to position as a portfolio. I mean, like we have found most of the opportunities in small and mid cap space, but it's nothing like that I'm allergic to large cap space. If I find good opportunities, reasonable valuations, and if I'm able to understand the business, I would invest in a large cap space. It just so happened that a lot of these are small companies in small and mid cap. They have one line of business. And that's why they're much easier to understand. I could read an annual report of a company in a day or just in a few hours. While if I were to start looking at, say, something like Reliance or for that matter, any large company, it would probably take me months to just read through that one annual report or maybe make sense. So it's, as I keep saying, it's an algebraic equation. The lower the number of variables, it's easier to solve. So for a passive investor who is just simply investing on the basis of large cap, small cap, mid cap, I would rather say go and invest in a mutual fund. Mutual funds are doing quite well in India. Okay. And they have generated an alpha in general, I think. And so if your thought process only in terms of large, small, mid cap and not in terms of what stock you are investing in, what business you are investing in, then you should go for a mutual fund. But once you start looking at it as a business, as a stock ownership, then it kind of becomes immaterial whether you are investing in large cap, mid cap, small cap. As long you are understanding business, as long you know why you are investing in that business, and you have some idea as to why you will exit if something pans out. So we just find it more comfortable being in small mid cap because we are able to understand those businesses easily. As far as liquidity is concerned, I think for most of us investors, or at least students, if you are starting new, I mean, liquidity won't be an issue at all for you guys. So I mean, a lot of large investors having portfolios of 500,000 crores, Ashish sir, Vijay Kedia sir, they all are investing in the small mid cap. They obviously are aware of liquidity issues and all, but it becomes more important or more pronounced at their kind of portfolios. So I think you shouldn't be so much bothered about liquidity per se, but you should be bothered about it if you are just looking at it, if you're not analyzing the business or not understanding the cycle. In that case, you should go with a mutual fund.
Okay, sir. And sir, one more question, sir. Do you follow any particular indicators to understand that what theme or segment of market is currently in fancy? As we have seen that earnings growth along with multiple expansion leads to fastest wealth creation. And when market get attracted towards a theme, the business get re-rated quickly. In a different language, sir, how do you analyze tailwinds present in an industry or a sector?
So I think we should do that. We haven't been doing that. We are more a bottoms up stock picker than top down approach. So we haven't like kind of done analysis that way. Okay, this industry has these tailwinds coming in, and that's why. In fact, our approach has been a slightly different, wherein we are trying to be, as I said about cyclical opportunities around, wherein the industry may not have any tailwinds at all, but it's all like completely dried up, no interest, nothing, and the valuations are low, everything is low, and the stocks are butchered, battered, and you're buying. So, but what we are trying to do is we are trying to position ourselves to be lucky because market has no interest. there's no expectation from the company and the stocks are already very badly placed. So if at all tailwinds come in due to cyclical factors or structural factors, we could make huge returns. Else we'll make small losses or maybe like cost to cost and we'll exit. But yeah, you could still do this kind of tailwind analysis or look at factors. I mean, I think someone like, say, I think Nuresh does well in this space. He looks at charts which are breaking out of, say, 52-week high kind of a thing. You could get some idea. I mean, sometimes there are stocks or sectors which are breaking out after a long consolidation. I think it happened with, say, real estate. It happened with metal space. It happened with, I think, capital goods and all, or maybe even a hotel space. So you could look at that way, wherein stocks are breaking out of a huge consolidation or making some, say, 52 weeks high now. So there might be some tailwinds in the sector that might be happening, and that's how you could find opportunities. Or sometimes you could look at where the insiders are making their move, where the insiders are kind of increasing their allocation. By insiders, I mean the promoters and all. If they are kind of, if you could find a certain pattern. So that's how you could get some opportunities and identify sectors.
Okay, sir. Thank you, sir.
Yeah, thank you. Thank you.
All right, sir. I think, sir, the last question will take from Shivani. She is currently again our Finnish program student. So Shivani beta, please go ahead with your set of questions.
Good evening, sir.
Yeah, hi Shivani.
Actually, sir, I learned a simple point from you that if we are competent in studying something, then we should study that only, instead of wasting something where we are not competent at all. Sir, I will, with respecting your time, I will come directly to my question. Sir, as we know that during 2016 demonetization and 2017 GST and liquidity crunches of 2018 by NROC and JLL, this was a very bad period for the real estate cycle, real estate business and companies. So, and one of your blog had also written about it, where the government took various steps. Even after this, the small players in the real estate industry were able to grow because the large people are unable to catch up the growth. But sir, when we see the industry research, the data seem contradictory, as majority of the unorganized players were wiped off. So, and I want to understand around it. And also, sir, what is the parameter? And sir, also, sir, how do you know that real estate cycle work and that all?
So frankly, we haven't made any investment per se in that sector. We were just kind of doing study analysis. And in fact, one of the studies that came out was surprising for us as well. As you pointed out, we too were expecting that a lot of small players would have been wiped out, unorganized would have been wiped out, and the consolidation would have happened. But I think, I don't remember the exact source, but there was a study which mentioned about the number of developers have increased, especially the small developers have increased in number over the last few years. So I think that was something that we just posted it that way. Frankly, we don't have any investment in that sector. We probably should have made, but we don't have any investment. But again, I would say, I mean, it's been an industry or that has gone through a very long consolidation or bad phase. Probably, I think 2008-10, since 2010-11, it's been a down phase. So that's how you could have looked at it, and you could have looked out at, say, breakout patterns in companies, or as I talked about in my response to previous question, wherein suddenly you start looking at companies making 52 weeks high or breaking. That's how you could have identified opportunities in real estate space. But the 2 points that we mentioned, we found those as contradictory studies and just posted about it, but did not work further on it.
Yes, sir. Understood, sir. And sir, if you wanted to understand, invest in real estate companies, then what parameters you would like to study?
Oh, so we haven't made any investment per se, so it would be too difficult for me to just point out. I think there are guys who have done much more study, or I think Jiten Bhai from Forum Capital, or I think even Jatin Khemani from Stalwart, they have done some investments in those, as far as I know, or some other investors. So they would probably be like better placed in terms of knowing what would be the best parameters to track and determine as to these could be the trigger points, or that's where you have to look for.
I think, sir, Gaurav Sood, sir, also.
Yeah,
right?
Gaurav Sood, sir, and Gaurav Sood and Manoj Dua. He's a private
Manoj Dua,
investor.
sir,
So Manoj, I think he has made decent investments in that space. I think 30-odd%. So, but we unfortunately we don't have any investment per se, and that's why I'm unable to answer.
No, sir, I understood. Thank you, sir.
So Ekansh, sir, just two general questions, sir, that we always ask to guests who are giving us this opportunity to interact. Sir, first question being like, there is a lot of reading material in the world of finance and investing, left, right, center. And apart from that general, premium categories like One Upon Wall Street, Intelligent Investor, Capital Cycle, Buffett Letter, etc. Are there some not that famous, publications or investor letters that you have found very useful in practical sense? कि यार ये बंदे एक्चुअली में काम की बात लिखते हैं जो कि अप्लाई होती है rather than general ज्ञान.
So I think Jiten Parma's study or those notes or his presentations on cyclical investing, I think that's something one should read. Very practical, very easy to understand, and will open up your kind of mind towards cyclical opportunities. I don't remember per se. I mean, Professor Bakshi, as you are aware, he makes things quite easy in terms of understanding. At least, if I remember correctly, around 2010-11, that kind of opened my eyes towards understanding the quality of earnings. So I started investing in 2008, but until then, I mean, my basic understanding was looking at sales numbers, growth, and PE. So, but his lectures, his study material kind of opens your eyes to, I mean, the quality of earnings aspect. And that's important because that's how you kind of, even though you may not be investing in high quality companies, but then you still get to understand other businesses as well at the same time. And if at all you get great opportunities in high quality companies, why not invest in those? So he kind of, it was helpful for us in terms of, I mean, so those are the, if I, otherwise, if you like, I mean, listen to general interviews of Vijay Kedia, sir. I mean, he again tries to make things understandable, very easy to understand. I think you have worked with Ashish Kacholia, sir, although he's not very public in terms of his, I mean, he doesn't speak often but at least I've kind of looked at his investments and if I find them very practical and very, I mean, it's quite, I mean, the way he goes about his investments or the stocks that he has invested in, or read what Shyam Shekhar sir has to say on contrarian investing or contrary style. I mean, we kind of get sucked in markets when there are narratives all around, when companies are doing well. As I said, when things are going good, you start believing everything to be high quality, while most of the time 99% of the things are very cyclical, some moderately, some that way. So his approach or his contra style, at least based on his tweets and whatever I have like seen or read, that kind of helps you develop that contra approach to your investing, and that's very helpful. That's where when you can start looking at opportunities where people are not looking, and you may not be making immediate money, but you would be making very decent money in 2, 3 years, 4 years on those opportunities. So those are some India-based materials that you could look at and that give very practical information per se in investing.
Thank you so much, sir, for sharing it with students. And sir, just one last question before we close the session.
Yeah.
Sir, everyone commits some mistakes or learn from others' mistakes. So, sir, like in your entire career, like, are there any mistakes that you would like to highlight that this young generation should definitely keep in mind when they proceed in their careers, both in the investing world and for general in their personal life?
So I think, as Charlie Munger says, you should be a learning machine. So one aspect that I find myself, I mean, it's my nature, and not very outgoing or not very interactive per se. But my suggestion, or if I have to say, tell my younger self, I would suggest, or even right now as well, I keep telling myself, talk to people who are better than you. I mean, just be around them and you'll learn a lot. Obviously, there are books you can learn from, But if you're, I mean, in investing space, there are so many people who are better than you. As I pointed about 3-4 names earlier, like I wasn't open to opportunities in say cyclical space, but I looked at say Jitin Parmar sir presentation and all, and I learned new things. Similarly, we value investors, fundamental analysis investors have this very hard mindset in terms of, okay, charts or these things are not, I mean, these are all like fluke and these are not worthwhile. But I believe if you are open to like kind of looking at patterns or understanding, you could still find something to add value. So it's about keeping an open mind to a large extent. Don't try and box yourself in a very very strong thought process. At least I, as an investor, kind of get some help by being flexible. Like this flexibility about understanding that what I'm thinking as a very high quality business may not necessarily be a high quality business and could be very cyclical. So this flexibility helps because it also helps you to kind of exit from those stocks or book your profits when cycle turns around, because otherwise you could have a very hard mindset and may not kind of change your position. And especially with markets, it's important to change your position and be open to learn new things as things change, because they happen quite often, because they happen because of market cycle, they happen because of business cycle. So flexibility, being open to, like, if you see someone doing good in a certain space, try and learn. You may not necessarily incorporate that in your strategy, but you could still try and learn. Similarly, I would say one thing that as a career advice, I think this tech space, I think people should try and learn about it, because it gives you kind of a tool or something. You may have an idea in your mind, and these tech guys or whosoever has learned some coding, they kind of are able to develop things which if I'm not a coder or if I haven't done any tech based thing, I'm kind of to a certain extent handicapped. So that is also a space that you should try and learn about or focus on. You may not necessarily do something great in that space, but it's okay to try and learn. So be open to opportunities, be open to learning in general.
Thank you so much, Ekansh, sir, for such a wonderful session. And sir, just one correction, sir. I actually started my career under Ashish Kila, sir, not Kacholia ji.
Okay, sorry. Ashish Kila is also like, I mean, he's a friend and he's a good investor.
Yes, sir. I heard actually your name in 2010-11, first time from him only, when I came across your learnings. I think, sir, with that, we'll summarize the session. And thank you so much, Ekansh, sir, from bottom of our hearts. It was brilliant, practical, to the point session.
So, I mean, first of all, thanks for the opportunity for bringing me onto your platform. And I just hope, I mean, all the students, whoever watches this, they get something out of it, out of whatever little experience I have in the markets. I mean, I think this is something which I'll keep on learning, keep on evolving. But I hope whatever I have learned till now, I have been able to like kind of share it with all, and they hope they get it.
Absolutely, sir. And just a final addition, like the top two names that you mentioned, Jitin Parmar sir and Sanjay Bakshi sir. Sir, actually, those are few of the guests, sir, who would be in our pipeline also for the coming months, and the students would love now to listen to them even more.
I think you are doing a fantastic job. I think when I got this opportunity and the way you are doing this and the questions and everything, I think everyone is gaining a lot. And I think, I mean, when you're bringing in, say, Sanjay Bakshi sir, Jitin Parmar sir, and all the other guests that you have had, I think they will add immense value to all the students and to the other audience as well.
Yes, sir, just trying to finalize just dates with them. And I'm just praying that they finally agree with the timeline.
I think they will do. They are always helpful, and they are quite helpful in terms of their teaching.
Yes. Thank you so much, sir, once again. It was a pleasure for every one of us to listen to you. Thank you so much, sir.
Yeah, thank you. Thanks a lot. Thanks for the opportunity.
Bye, sir. Please take care.
Yeah, thank you. Bye. Bye, everyone.